Meta reported their earnings after market close yesterday, and the market did not like their earnings one bit. As we can see in the pre-market today, they are down nearly 13% and they have continued to fall. We're going to find out in today's episode why exactly has this company that was a very strong grower over the last few months started to look like showing signs of weakness. We're going to take a look at a few articles to really understand if we need to be worried about the broader market as well. And as always, we're going to look at the historical performance of this company. We'll look at how they are growing their top line revenue as well as their bottom line net income. We'll look at the health of the company, total cash versus their total debt. And as always, we'll look to both insiders as well as institutions to see whether or not they are buying or in fact selling. And as always, we'll look at the dividend safety, although we do know Meta have only recently started to pay a dividend, and we'll look at their financial metrics, the free cash flow, as well as a lot of others. As always, we will run them through the valuation model, getting to our intrinsic value, getting to our acceptable buy price, given our investor margin of safety, and we'll look towards Wall Street to see what they are forecasting for the next 12 months. So let's start off with why Meta is crashing down almost 14%, and what we can see from this Yahoo Finance article is that with their results, they are growing their revenues very rapidly, 27%, and their earnings per share at a 117% increase year on year. So that is some phenomenal growth for this company, especially when you consider not too long ago, this was trading in the $100 region as well. Now, why has this essentially crashed just over the earnings? And we have to take a look and see what was discussed in the call. And we have as the headline, Mark Zuckerberg defends the Meta's AI spending as their share price tumbles. So in terms of looking at the actual numbers, what we can see, their revenues, as we mentioned, had increased 27% to 36.5 billion in the first quarter of 2024. We see that it also beat analyst estimates of 36.2, so a 300 million beat. So why then, with their earnings per share, with their revenue beats, what is the issue with this company? And one of the things that Mark Zuckerberg actually discussed was how they are looking to increase their spending and turn this social media group, when you think of the likes of Facebook and the other companies within it, like WhatsApp, like Instagram, they want to become the leading AI company in the world. And how are they exactly going to do this? Well, we can see here they raised the high end of their full year capital expenditure guidance from 37 billion to 40 billion so that they can continue to accelerate their infrastructure in the artificial intelligence roadmap. Now consider this, they spent $28.1 billion last year. This year they are now anticipating around 40 billion. So that is a very large increase. The market is worried with this spending, it may get out of control. And we can see for a long time now the metaverse has had a lot of money being plowed into it with no income being produced from it. Now, in terms of their full year guidance for the expenses, we can also see they have increased their lower range from 94 billion to 96, yet their forecasted revenue is still looking strong, 36.5 to 39, whilst we have the consensus estimates around 38.3. So some mixed results, yes, positive, yes, they are increasing on their revenue, they are increasing on their earnings per share, but the market is forward looking. They are worried about the increases to the costs for the artificial element that Mark Zuckerberg is really driving at this company. Is it overblown? Do we now have an excellent opportunity to invest in this company? Well, we have two buy ratings from Seeking Alpha and Wall Street. Now, we do note even after this drop, it is still going to be in the mid to upper end of the 52-week range. We can also see it does offer a yield, although very marginally, and the forward PE after this drop will be nearer towards the S&P average of 22. Now, it does have a very large market cap, 1.26 trillion, and still over the last year, it is up in the triple digits. Over the last 10 years, if you were a shareholder and you did keep your stock, even when it did drop down to around $99 in October 2022, you would be up 722%. So lots for us to consider in today's episode. Let's start our deep dive. On the top line revenue, typically 3 to 7% is the minimum baseline we look for more mature, steady companies. With Facebook, we expect sharper increases, and December 2014, they reported 12.5 billion. latest annual accounts 135. So we can see this is a company that is increasing their top line at a very rapid rate, and as we just heard earlier, they have also increased it 27% over the last period. So very strong in terms of growth on the top line. When we look at the bottom line, how does that compare? Well, they have increased it very rapidly as well, from just under 3 billion in December 2014 to just over 39 billion in the more recent period. And we can see when we do look at the graph, although we do note the drop in 2022, it has rebounded and is looking likely, based on the guidance, to continue to increase. So the numbers are looking positive in terms of the health of the company, their total cash versus their total debt. What we note here is cash has increased from 11.2 billion to 65 billion, and in fact we do see an increasing trend where they are holding more and more cash over the longer time period. When we compare that 65 billion to their total debt, numerically and directionally, we can see here 233 million in 2014, 38 billion in the latest annual report. So they have more than enough cash to pay off all of that debt, but we do also want to point out that it has been increasing over the longer term, and there will be some worries if they continue to spend on this artificial intelligence roadmap that Mark Zuckerberg is planning. Could it get potentially out of control and take a massive bite into their bottom line if they're not able to increase that top line with that increased expenditure? So let's take a look at some metrics. Now, the growth grade that they get is an A-, so fairly solid. When we look at their year-on-year growth, 15.7%, a lot better than the sector median of 2.5%. When we look at the forward growth, 15.3%, again, it is better than some of the industry leaders on average in this area. And when we take a look at other metrics, very, very strong. One that I also like to look at, forward looking, they are expecting over the next 3 to 5 years to increase their earnings per share by 22.13%, where we have others in the sector at 10.2%. So very good on the growth forward looking as well as historically. When we look at the profitability, they get the best rating possible, an A+. Gross profit margin, absolutely phenomenal, just under 81%. Sector median coming in at 49%. When we look at the bottom line, 29%. Again, we can see the sector at 2.6%. And if you do want, you can take a look at these other metrics, but they all do look very, very strong. Now, what we can quickly do is see how they've performed against others in the interactive media and services industries. We have Alphabet, we have Tencent, Baidu, and some others. Now, when we compare it over the longer term, over the last year, we do see Meta up 132%, the best performing out of their competitors. When we take a look over the last 5 years, again, we can see quite clearly they are a very, very strong company. They have been outperforming all of these competitors over the period. And when we extend it to over the last 10 years, no other company does come close. We can see 717%. Do bear in mind, though, especially for newer viewers, that past performance is never an indicator of the future. They could perform much better over the next 10 years. They could also perform a lot worse. Now, one thing we have noted is a significant amount of insider selling, just under 1 billion over the last 12 months on 6 different occasions. We note the largest one did come in Q1 of 2024, but also some selling in Q4, as well as some in Q2 of this year. Now, who are those insiders? Well, we can see, in fact, the COO has recently sold the 19th of April, so not too long ago at all. In fact, before the share price drop that we see today, $245,000 worth, and we see a few other insiders as well. Notably, what we don't see here is that Mark Zuckerberg himself did sell quite a number of shares. Very interesting to note whether or not you want to include this into your own investment thesis. That is something that is completely up to you. Necessarily, though, I wouldn't say it is a bearish signal. What I do quite like to see as a bullish signal is insider buys, which we haven't seen. Institutional ownership just under 80%. We see 42 billion worth of sales by the institutions over the last 12 months, but we see a significant amount more, although we note the largest of these buys came in Q2. However, both Q3 and Q4 of 2023, we see a lot more buying. Q1 as well, we do see, in fact, nearly double the amount of buys than we see sales. So interesting to note, with Meta Platforms, institutions are buying more, not just over the last 12 months, but as we can clearly see in Q1 of 2024 as well. So again, whether or not you factor this into your investment thesis, you can, but what I would say is do your own due diligence and never just copy their trades, whether it's institutions or insiders. Now, before we jump into the financial metrics, just to let you know, we have released our latest free weekly article. Lots of people ask, what websites do we use? What are the resources? Well, we discuss it all. If you want to gain access to this or any of the other articles, all you need to do is click on that pinned comment below and you can start reading straight away. Now, dividend safety score, we will touch upon it. They have started to pay a dividend, so it is 70, it is safe. Market cap just over 1.25 trillion, so it is a mega cap company. In terms of the recessionary metrics, well, the only one we have available is the recession sales, plus 154.1%, significantly above the S&P, which was negative 12. Now, in terms of dividend yield theory, it isn't one that I would say we pay much attention to, given the fact that they have recently paid a dividend. But what it typically would tell us is undervaluation when the current yield is above the 5-year average. What we do know, though, is the forward P at 24.6 is higher than the 5-year rolling of 22.3, and when we compare it to the communication sector PE, Meta does sit higher, although you could argue that communications maybe isn't the right sector to compare it to. Regardless, any of these metrics, we never take a look at them in singularity and will conclude on this company towards the end. Now, free cash flow payout. As always, we focus on the free cash flow. Below 60% is my personal preference for the majority of companies, as it means that they are able, in my opinion, to offer those double-digit dividends we love to see. Now, given it is the first year, they are expecting this to be around 11% of the free cash flow payout. I would be very, very shocked if we don't see some very strong dividend growth from Meta over the course of the next few years. Free cash flow, extremely important. We want to see increasing free cash flows with any company that we invest in, and we can see over the longer term this has been done. We do note the massive drop in 2022, hence the massive sell-off that we saw, and we do note 2024 is expected to continue to increase. So lots of positives to note with this company. They are increasing their free cash flow, and as we saw, their sales growth, double digits nearly every single year, absolutely phenomenal. Again, another reason for the sell-off in 2022. We did see a negative 1% drop to their top line, and what is expected in 2024, around a 27% increase to their top line. So it is continuing. So a very fast-growing company, a lot more than those more mature, steady companies that we tend to see at 3 to 7%. Numerically, another way of seeing the numbers of the revenue that we saw earlier, and on the shares outstanding, what we like to see, companies doing share buybacks. What this means is they return excess cash to the shareholders, as then essentially you are getting more portion of the company. Now, what we note, they have issued shares, diluted your position, but they have also over the last few years done share buybacks. The net position over the longer term would be a very minimal share buyback position. ROIC, return on invested capital, I want to see 10% or more, just to give me faith that management are able to effectively allocate their capital. We can see it increasing very strong, 26% in 2023, 30% on a trailing 12-month basis. So this does make it incredibly attractive to those shareholders who are sitting on the sidelines and who are effectively happy with the valuation. Margins very, very strong, well above the 12%, well above the 5% on the free cash flow, so it is very healthy. The only thing we would say, it is a little bit inconsistent. We don't know any operational efficiencies, and on the free cash flow, it does look like it has decreased over the longer term, but still significantly above the minimums that we want to see. Net debt to EBITDA, so this is the earnings effectively before the interest, tax, depreciation, amortization, and these would be numbers typically that would show us the number of years it would take the company to pay off all of their debt net of cash on hand. Now, with Meta Platforms, it is 0, which means it wouldn't even take them 1 day to pay off all of that debt net of cash on hand over the last 10 years and into next year. As we saw, their balance sheet does look very strong. And what I would say, this does also correlate to the dividend safety. So their dividend also looks to be very secure as well. Granted, though, they did just start implementing it this year. Now let's jump into the valuation of Meta. As always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these episodes as they drop. Now, typically, the first model that we would start off with would be Graham's valuation. However, for companies that are growing very rapidly, double digits, it is essentially irrelevant. So as we have the first model, the multiples valuation, companies in a similar sector and size, we have their stock price, earnings per share, the P multiple, average multiplied by the EPS of Meta, and we get an intrinsic value, the first one showing undervaluation, so a very positive sign, but bear in mind we don't look at any of these models in singularity. The second model that we would use, dividend discount model, however, it isn't fair given the fact they only just started to pay a dividend, so we may use this over the next year or two. We then look at the DCF model, discounted cash flow model. Now, we have been extremely conservative here. We have the free cash flow year on year. Average growth rate over the last 10 years, 36%. We have gone for 10%, which we believe to be incredibly achievable. Just last year, they increased by 128%. In conjunction with the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and we get an intrinsic value of $567, another undervaluation signal. So the intrinsic value in today's episode is just the average of these two models, and as always, you can grab a copy of the valuation model to get to the intrinsic value as well as the acceptable buy price of companies in your own portfolio by clicking on the pinned comment below. Margin of safety. Now, what we typically use is 10%, and we execute on this if it meets 3 golden criteria: a wide moat, strong financial metrics, and good forward-looking data. We then keep going till it's near the current trading price, and what we can see in today's episode for Meta, it isn't at a 25% just yet. It is right now between a 20 to 25% level, and you could argue that is a lot of value as it does meet a lot of those 3 golden criteria, so some people may be happy to pay a 10% margin of safety. In terms of Wall Street and their expectation over the next 12 months, they pretty much see the value going near enough to our intrinsic value. They see upside of 28%. They do consider this to be a strong buy now for the portfolio. And as always, do let us know your thoughts in the comments below. This is one that I do hold indirectly through ETFs as opposed to directly. But if this is one that continues to drop today, then it may be one that I could get a little bit excited about. If we see it around a 25 to 30% margin of safety, so around the $400 mark, this is one that I will start to dollar cost average in, as long term it does look very, very strong. When we take a look at this company, they are increasing their free cash flows on average by around 36% just last year. Very strong. The only thing you need to consider with this company is the future, and if you're worried that Mark Zuckerberg will be spending too much money in making this an AI company as opposed to doing what they do very well with those increasing free cash flows. As always though, do let us know your thoughts in the comments below. Is Meta now one you're going to be looking to add? Is it on your watch list, or maybe for whatever reason it isn't one you want in your portfolio? As always, have a great day. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button, and as always, we'll see you all on the next one.